and welcome to Looking at the Markets with David Moadel. I don't want you to trade like most people. I want you to trade better than most people. And one way to do that is through options. If you can afford to buy 100 shares of a stock, then you can write or sell a put option and buy at cheaper prices than most people will. I know it's not always possible or easy to buy 100 shares of a stock, because some stocks are expensive. But you can look for less expensive stocks, like Ford, for example, is not the most expensive stock in the world, and maybe you can afford to buy 100 shares of it. Don't force yourself, okay? I don't want you to buy 100 shares if you can't really afford it. But if you can, then maybe consider selling or writing a put option, okay? So I'm using the Schwab interface here. And let's take Apple, for example. Okay, if you can afford to buy 100 shares of Apple, you can type in Apple and then you go to stock and you could just buy 100 shares. Okay, I get it. And it's around $161 as I'm making this video, a little bit more. Or you can buy it cheaper. Yeah. How do you do that? You just write or sell a put option. You go to put and then you go sell to open, one of them, because one put option represents 100 shares of a stock. And if you don't know about options, I have plenty of videos on options, so check that out. Look through my past videos and my playlists. I have options playlists for you to learn from the beginning. But it's really simple, and if you want to apply for options trading permission from your broker, feel free to do that. It's up to you. Okay, there are risks with options. You have to know what you're doing. And always have an exit strategy, all right? Don't just go in there without some sort of strategy to get out if the trade goes wrong. But with selling a put option, what's the worst that could happen is that, let's say with this one, strike price of 160 with Apple stock trading at 161 and change, okay? The worst that happens is Apple goes down and you have to buy it at 160 per share, 100 shares, one put option. But really, are you buying it at 160 or are you buying it at 160 minus whatever you got paid, which is $1.50 per share? So really, you're buying it at 158 and 50 cents if you think about it. So if Apple stock is trading at $161.50 or something like that, already by buying it at 160, you're buying it at a discount from the current price, and then really net, you're buying it at 158 and 50 cents because you got paid $1.50 per share. Wow, you're getting it at a better price than almost everybody else, because what do most people do? They just buy the stock. That's it. They buy it at the current price and hope it goes up, okay? But you're giving yourself a little bit of a cushion because you're getting paid a premium there, and you're also buying it already with the strike price lower than the current share price. Not a bad way to go. And this is going to expire in just a few days. What if you go further out? If you extend your time duration, hey, you get paid even more, quite a bit more actually. All right. So you're buying at an even lower price net because you're getting paid a bigger premium. You just have to be a little more patient with it because now you're extending the time duration, so you're maybe going to be in the trade longer in order to realize the full profit potential of this. All right. Now things could still go wrong. Okay, the stock, Apple stock, could still tank. It could go way down, and then you're buying at an unfavorable price. You're buying at 160, and Apple might go to, I don't know, 150, 140, whatever. But you're still getting a better price than somebody who just bought the stock at the current share price of 161 and change. And you only want to do this with stocks that have gone down, most likely. There are exceptions, okay? Some people like to buy stocks that are going sideways or went up, and that's fine. Maybe there are reasons to do that in some instances. But I'm looking at finviz.com right now, and I'm looking to find out what went down. And hey, Apple went down a little bit today, so that makes me think, yeah, okay, maybe sell a put option. I don't want to do it like with AMD, which went up a lot today, okay? Because you're not going to get paid as much for selling or writing a put option on a stock that has just gone up recently, okay? And just, this is one day's price action, okay? You can change it. Maybe look at how it's done over the past week or month or year, something like that. It's not all about what happened today or over the last day or 2 or 3 or 4. It's about performance over time. If something has really gone down a lot and it's a huge company like Apple or Microsoft, something like that, then hey, maybe it's time to get in, okay? And then be aware of earnings as well. You want to look at the earnings calendar and say, oh boy, okay, maybe the options premium is high. Maybe it's really high because there's earnings coming up, and do you really want to take a chance necessarily? If earnings is tomorrow or the day after or in a few days, then the stock price could go way up. Sure, it could also go way down, and you could be in a bad position then. And so if, let's say Apple, the put option was paying a whole lot for the short term, the one expiring in a few days, if this wasn't $1.50, if it was like $5 or something, I'd say, wait a minute, that's a little too good to be true. Why are they paying so much? It's usually not that much. So you look at your earnings calendar, and this is on stocktwits.com, the earnings tab. And, oh, okay, yeah, now Apple does not have earnings this week, but let's pretend if it did. If I saw Apple up here on the list, oh, earnings is tomorrow or the day after, then I would probably just stay out of the trade, okay? So again, to recap, you want something that's gone down if you're going to sell the put option. You want it to be a really great company. Okay, it doesn't have to be a large cap necessarily, but I'm looking at large caps right now on this screen on FinViz. You want to make sure earnings is not coming up probably. Well, some people play earnings. Okay, you can if you want to. It's your choice, but oftentimes I will choose not to do that because it might not be worth it. Yeah, you collect more premium a lot of times when you sell the put option, but boy, you're taking kind of a chance, okay? Because I've seen some stocks go down a lot. Do you remember what happened with Snap stock recently? Yeah, it snapped. Went way down. Intel stock went down quite a bit as well, and there's some other examples there. So check for earnings, make sure it's not coming up soon, and that might be a better way to go. All right. Again, there are exceptions to all these things. Make your own decisions, do your own due diligence. Options involve risk, but really, what's the big risk if you wanted to buy 100 shares of the stock right now anyway? Why not consider applying for options trading permission with your broker if you're ready to try this, and sell maybe an at the money or close to it or slightly out of the money put option, and then you can buy at a better price if you end up buying. You might not end up buying the stock. Maybe you sell the put option and the stock price goes up. It doesn't go below the strike price. You don't end up buying the shares, 100 shares. Fine. Hey, you got paid free money through the premium payment you got paid. It's not the worst thing in the world to get paid free money, right? So there you go. It's not really free because you're taking on some risk, of course. But you got paid, and you sold somebody a contract that expired, so that's not a terrible outcome, is it? Okay, so something to consider. So check out my options playlists. I have a couple of those, and be careful out there. Think of ways to not trade like everybody else. Think on your own, make your own decisions, and I think you'll do okay, hopefully, potentially in the end. Thank you so much for watching and listening. I will talk to you again soon.